Hello and welcome to this Edison audio interview with James Henderson and Laura Foll, the fund managers of Law Debenture Corporation. It's Wednesday, the 8th of July, and I'm Sarah Godfrey, a director in the investment companies team at Edison. So James, Laura, hello. Thank you for joining us. To start then, now all fund managers like to think that their fund is unique, but Law Debenture really is a bit different from most. Please, James, could you explain how?
Well, it's a hybrid. It's got its own 100% owned operating company. This company accounts for between 15 and 20% of its NAV and about a third of its earnings. This is a professional services business. It's a trustee to pension funds. It's a trustee to bond holders. And it does various other activities, including SafeCall, which is a whistleblowing service. It's an old established company. It dates to the 19th century. It is what drives the portfolio, some of my portfolio thinking, because it gives us a third of the income. Therefore, at the start of every year, we know where some of the income is coming from. This gives us more investment freedom to buy across the market, large, medium and small companies, and also companies on lower yields, and produce an overall yield that we think is attractive.
Thank you. So Laura, in this time of widespread dividend cuts, presumably their structure is quite a help for you as fund managers.
What it means in any one year is that we've got, a way to think of it is that we've got roughly a third of the income, as James was saying, in the bag, and we know that, and that means that we can invest across the breadth of the UK market with a small amount overseas as well. And if you looked at our top 15, quite a few of them, unusually for an income fund, would be zero yielders and would be zero yielding for the foreseeable future. So things like Ceres Power, we know full well that that won't pay a dividend for really quite a few years. And things like Herald Investment Trust don't pay a dividend either. And we can do that. We can invest in those zero yielding names while knowing that we're paying a near 5% dividend yield to shareholders. And it really is because of that professional services business that we're able to do that. And I think the relevance has become even more important in a year like this, where, as you say, we've seen so many dividend cuts across the market, that the sectors that are continuing to pay dividends are now quite narrow, and quite defensive in nature. Things like utilities and pharmaceuticals, tobacco. And in this fund, we're not just restricted to those areas. We can still invest across the market. I think that's quite unique and particularly relevant in a year like this.
Now, Law Debenture is just one of the funds that the two of you run together with others, including Lowland Investment Company and Henderson Opportunities Trust. How does the way you run this portfolio differ from your other funds?
It has 20% of the assets are overseas. We have about half of them in Europe and half of them in America at the moment. That it has less in smaller companies than Lowland or Hot, and it has a lower tracking error. So it has about 130 holdings. It's a broad fund, relatively lower risk. This is because it has its own business that is going well in recent years, and therefore, to make it a unique investment proposition, it doesn't need to be taking so much investment risk.
And are there areas where it's more similar?
Yes, there are. There are some crossover holdings, and it's got some of the same biases as our other funds, because that's where we believe the best returns are going to be achieved. It has a lower portfolio yield than Lowland, but a higher portfolio yield than Henderson Opportunities Trust. So it sits in the middle as regards that. It has a longer list than the other two at the moment. This is to diversify and lower the overall portfolio risk, which is lower than in other trusts.
So Laura, Law Debenture has outperformed the UK equity income peer group over both the short and longer term. What have been the drivers of this outperformance, and to what extent has the overseas exposure that James just mentioned contributed to those returns?
The overseas holdings have definitely been a contributor. I'd say there's a few different drivers, but certainly things like Microsoft, which we very recently sold, Applied Materials. We used to own Becton Dickinson. Quite a few, particularly the US holdings, have been large contributors. If you looked over a 3 or 5 year time period, they'd often be among the best performers. So certainly the overseas holdings has been one of the drivers. I'd say there's a few others. More recently, the alternative energy names that we've held have been very strong contributors. Those are Ceres Power and ITM Power, both of which are exposed to hydrogen and the hydrogen supply chain. And they've been very strong year to date. Even in a very difficult market, they've been up substantially in absolute terms, that is. And it's really driven by just growing interest in the area and the need to decarbonise effectively the economy. So alternative energy names have also contributed. And then just more generally, we do have, as James said, this is among the more large cap of the portfolios that we manage, but there is also a fairly sizable small and mid cap element, and quite a few of the mid-size holdings have been strong contributors over time. And so be names like Hill and Smith, Marshalls, Green King until it was taken over last year. Good, solid UK companies that have got very strong management teams and have re-rated quite substantially in recent years. So I'd say it's a combination of those three things. So alternative energy, overseas, and some of those smaller and medium-sized companies that have really helped the performance.
Great. And quite impressive to have outperformed everything over such a difficult period. So James, speaking of the difficult period, have you done anything differently with the portfolio as a result of COVID-19 and the market volatility that's gone along with that?
Yes, we have been net investors for April, May. We've put about 27 million into the market. This has been an increase of the gearing, so it's now about 17-18%. This is because in the medium term, and it's one of the privileges of running an investment trust, you can take these longer term positions knowing you're not going to get cash redemptions. And we believe that stocks in the medium term sense are cheap. This has allowed us to up the gearing, and we've done that predominantly in the UK. There's been a bit of buying in Europe. In fact, we've kept reducing the States because the valuations are higher and the prices haven't come back in the same way as they have in the UK. So hopefully we're using this period of weakness to buy good long-term investments that will in time be back on the dividend list if they're past their dividends at the moment, and back on the dividend list at good historic yields, and this will grow the revenue out into the future.
So talking about those companies returning to the dividend list, there's been a lot of speculation about the likely shape of the economic and stock market recovery from the pandemic. But what do you see as the outlook for dividends, both in the UK and beyond? Laura?
Sure, perhaps just a bit of context before we talk about the outlook. On various people's numbers, the UK dividends, this is for the market rather than for the portfolio, are forecast to fall about 35 to 40% this year. So materially worse than the financial crisis. And at one point, it's softening a bit now, but at one point the default was really for companies to put out a COVID-19 trading update and almost as a default suspend the dividend at the same time. So a really unusual situation, the UK having historically had this dividend culture where companies try and maintain the dividend. That's been severely disrupted by this year. I think we're now getting a clearer idea of when companies will return to paying. We're just starting to see a few companies come out, names like Taylor Wimpey, which is one of the big house builders, have come out and said calendar year 21 we will return to paying. Land Securities said something similar, put a timeline on it last week. So we're just starting to see a few companies say they will return. I think what we'll see is dividends will recover at least to a degree next year in 21, but not to the same levels that we saw in 2019. Companies like Royal Dutch Shell which has cut its dividend by 2/3. That's a permanent rebasing, and I think we'll see that from other companies as well. You know, the likes of possibly the likes of BP and HSBC. So I don't think we'll see dividends fully recover next year, but I do think we'll see a recovery, and I think that recovery will continue into 2022. And I think what we'll see as well is some of the companies, you know, as James mentioned, we have been a net investor year to date. And for some of those companies that we're buying this year, and I'd include names like Halfords, like Marks and Spencer, you know, when they do return to paying a dividend, which we think they will in a few years' time, I think the prices that we're buying them at now, the dividend yield could, you know, when they return to paying, look attractive, and that will be very helpful for the income account in a few years' time. Although clearly, you know, for retailers like that have been very affected, it's not right for them to return to paying a dividend sort of imminently. But it's just, you know, in say FY 2022, I think the dividend yield would look attractive.
Now, James, earlier on you mentioned that the Law Debenture portfolio shared certain biases. You said that appear in some of your other portfolios. Now, I mean, it's probably fair to say that you and Laura are seen in the market as having a value slant, which I know has been a bit of a dirty word in recent times. But is it fair to say that with Law Debenture, you're not so much about the unloved as you are the unknown?
Yes, I think with all portfolios, what you want is diversity and blend. And certainly, I believe that companies that are having a difficult time, but are looking at themselves hard and have a business at their core that is a good business, will recover if the management keeps pushing forward, if the product is good enough. And so I'm always on the lookout for recovery type situations, and there is definitely a recovery element to the portfolio, and that is a value approach. But we need diversity. We have a longish list so we can get that diversity. So there are elements of the portfolio that are growth. And you need to look at those differently in your valuation metrics than you do the recovery type situations or the value type situations. And different bits of the portfolio will perform differently at different times. At the moment, it is actually the growth names, the companies that are where there is an element of blue sky, you know, where there is real potential, that are attracting investors. I think in time that the recovery situations, when the recovery does take hold in the UK, the companies that are having a difficult time at the moment, but are focusing on what they do, are surviving, will attract investor support. So it is about having looking across the market and thinking whether at the company's core it's an excellent company, it has excellent product, excellent services, and then the overlay where the economy is going. I don't know when the recovery happens. I don't know how strong it will be, but what we believe is that good management teams do get through to the other side. Some of those companies at the moment aren't being as tested as hard as others. Some companies where they're less affected by the lockdown are coming through with good results, and they are seeing support from investors. But that will change. Investors will look for the next story, and the next story could be quite a dramatic recovery in places in the economy, and then it will be a different sort of company that leads the market up. We don't trade, substantially. Our turnover is relatively low. What we like to do is just be in companies that, whatever the conditions they're facing, have got those disciplines to see them survive and in time grow.
Now, obviously, we've all had to get used to some new working practices over the last few months. But you know, as co-managers who work really closely together across a range of different mandates, what have been the challenges and surprises of working through the lockdown for you and James?
Yeah, I would say the challenge is that sometimes, and I'm not so much talking about the communication between me and James here, but I would say sometimes the challenges are you're not generally seeing people face to face. Obviously, sometimes you are in Zoom calls and things, but mostly you're not. And sometimes you can miss what someone is trying to tell you in reality. You know, if someone's looking quite uncomfortable, feeling quite uncomfortable, it doesn't always come across on a phone call in the way that it would if you were sat right next to them. And I'm talking more about talking to management teams of companies here. So it's taken a while to kind of realize that and realize the value, I suppose, of seeing people face to face sometimes. I think that being said, what I've really learned, and I think I'm going to try and carry this through to when things go back to being in the office, is we don't need an hour. You know, I can chat to companies for 20 minutes and catch up, and that's all that needs to happen. We don't need these hour-long formal meetings. You know, a lot of these companies we've held in the portfolio sometimes for 5-10 years, and that in some cases quite specialist small companies. We don't need an hour-long meeting. We can have much quicker, more efficient meetings and get through a lot more company meetings in a day. And generally what I found is during this period, companies are really keen to talk, particularly in the really difficult times in sort of March and April. You know, me and James were just having so many calls from company management teams that wanted to speak, and that was really, really positive. And generally I've been quite amazed in some cases at how well management teams have responded in an environment that they just would never have predicted, and no one did. But I've been really pleasantly surprised by how they've responded.
Great stuff. So yes, human ingenuity will prevail. Well, James and Laura, thank you very much for that run through on Law Debenture, which is a research client of ours, so there will be a note out at some point in the next month or so. Yeah, so thank you for your time. This has been Edison Audio with James Henderson and Laura Foll of Law Debenture, and I've been Sarah Godfrey from Edison. Thanks very much.